Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by Nicole Dines, James Wallace and Dan Innes. And we'll also have a special focus on Iberia. Dan, what have you been seeing?
The FT raised quite a few interesting issues, things like considerations around equality, how to treat workers who are more vulnerable to the virus because of age, gender, ethnicity, suggesting some guidelines that don't absolve employers from their existing legal obligations to keep workplaces safe. Many people who now also feel they need to take more responsibility for the needs of their employees and taking that into account. The Telegraph looked at other sides of the coin, ending office life altogether after Twitter told its 4,000 global employees on Tuesday that they could work from home forever if they wanted. And people praised Twitter's approach for being flexible. And again, in the Telegraph, people sort of speculating about what the future of the office might look like, including the British Council of Officers and Cushman & Wakefield conducting a survey which took data from about 1.5 million sources. And they felt that around 72% of staff expected their companies to embrace flexible working after lockdown. So returning to the workplace, it has been key. Another big story that Amazon might be looking to acquire AMC Theatres, the parent of Odeon Cinemas in the UK, Ireland and Scandinavia. They've got almost 450 cinemas with UCI in Germany, Italy, Portugal, Cinesa in Spain, Filmstaden in Sweden. So, globally, 11,000 screens. If Amazon take control of that, that's quite a tasty thought as to what that might do for the global leisure industry. And of course, that was after they acquired Whole Foods back in 2017 as well. So buying back into bricks and mortar is quite interesting. And then a piece that actually broke in This Is Money with Daily Mail with Helen Cahill earlier this week was that RBS had been exploring what renters would be doing versus mortgage holders within the next 10 years. They forecast that renters aged 35 to 44 would outnumber mortgage holders by 2029. And that's massive news for the build-to-rent sector. I think everyone that's looking into investments into BTR is going to be focused on that in a big way. So that's companies like Moda Living, TP, Get Living.
Great. And that's interesting because that really picks up on some of the trends that we've been seeing. Nicole, what key things did you see this week?
UBS had a report on the office sector, which again, a negative outlook with lower rents and more vacancies even after so the effects of COVID-19 have an impact on the sector well beyond the short term. And there was an interesting data from Ernst & Young about the fact that in the first quarter of 2020, there's been 2 years worth of profit warnings in the real estate sector. So 313 in Q1 compared to 303 for the whole of 2019. And obviously, all the companies attribute this to the pandemic, but the report makes clear that some of it is problems that were already there that have been accelerated.
It's interesting that I saw also that there was a piece around density. Thanks to Matti Schenk for including that on his LinkedIn. But from a New York Times article around now is the time to embrace density and saying that this is also true for Germany. And coming back to your point, Dan, there were things I saw particularly coming from Poland actually, but a Reuters story around Central European business services are looking at opportunities driven by the crisis as CEE, particularly Poland, Czech Republic, seems to be coming out of the crisis slightly earlier. Which is interesting in terms of that office space side. And also just in Poland, you're beginning to see shops reopening. And I also saw from Germany as well, thanks to Johnny Doughty for this, restaurants beginning to work their way around how they can come back and serve customers again. James, what was your sort of key thing this week?
Yeah, I had a look at the results from Land Securities, which is the UK's largest REIT. It gives us a bit of an insight as to the sort of state of prime property, particularly obviously in its segments where it's dominant, which is London retail, regional retail, leisure and hotels and offices. They revealed that their £13 billion portfolio collapsed in value by about 1.2 billion in the year to the end of March. And a quick look at the numbers shows that where that valuation falls were greatest was in regional retail, down 27.5%, followed by retail parks at just over 25%. And London retail was down just under 16%. Hotels and leisure was more like just shy of 11%, and offices was slightly up, which at 1.9% positive, which although values are stable, Land Securities did say in their results that less than 10% of its office space are at the moment in use, which is quite astonishing. Obviously, their developments were hit too. The complete developments are down about 28%. And so they're in this difficult situation of both having to play defense on their build portfolio and having all this kind of development coming online to kind of build this extra value that now is going to be extremely hard to kind of find tenants for. I mean, what actually the relatively new CEO, Mark Allen, said in his statement was that they actually expect far worse to come. And they are actually preparing for a greater number of tenancy defaults. What is bad for Land Securities is the biggest, and their capital base is extremely stable, is going to be worse for their peer group, including British Land. They were supposed to have published their annual results last week, but they decided to delay it by 2 weeks. So we'll expect those to come in about a week and a half time, and they'll probably show even worse figures than Land Securities has. And in late July, Intu and Hammerson are going to be releasing their interim reports, and they probably will show even a greater valuation decline.
There were some interesting developments in terms of Intu as well in Spain, I noticed, Dan.
Yeah, this week Intu completed its sale of its largest shopping centre in Spain to Spanish investment group Generali Shopping Centre Fund for just smidge over 475 million euros. Intu will obviously be looking to use the net proceeds of that to repay down its debts. The transaction reducing loan to value by about 1%. The centre is Puerto Venecia in Zaragoza. It's in northeast Spain, has an annual footfall of about 19 million people, and Intu will take about 200 or just under 240 million euros, and the rest of the sales value to go to co-owner to CPP. The Canadian Pension Plan and Investment Board. So really that's a transaction that's going to be part of Intu's strategy to fix its balance sheet. We
looked at Iberia a little bit in one of our sessions this week. What was your takeaway from that, Nicole?
Well, as Dan was saying, it seems that Spain is back in the trend because the two sectors that have been worst affected in Europe, which hotels and retail, seem to be particularly active in the Iberian Peninsula. And one example is the recent sale of Sierra Prime, that's 6 shopping centers for over 500 million euros, and with the big investors like Allianz Real Estate among the buyers, which obviously shows there's a lot of interest there. Again, there have been a lot of deals in the hotel sector as well. Palm Invest, Portuguese investors investing 300 million euros in a portfolio of 12 hotels, which shows the confidence both from European investors and from local investors, because these are two sectors that are obviously crucial to Spain and Portugal, and there seems to be a belief that after this crisis, tourism will obviously pick up again and grow at double-digit figures as it has been doing for many years, and that the pattern of consumer behavior in Spain, which very much focuses on shopping centres, will again carry on.
In Spain, there may well be an opportunity for some investors to kind of pivot towards more warehouses, digitalized warehouses, as global supply chains look to reorient and diversify away from China and come back a bit more locally within Europe. The countries that have been so decimated by COVID and, of course, the economic contraction that's followed that may look to benefit from increasing their sort of presence in the logistics and warehouse and fulfillment space.
Yeah, I think that's a very interesting one, James, and something to watch. Thanks, James. Thanks, Dan, Nicole. And thank you for joining us, and look forward to seeing you next week for our regular roundup of the key themes in real assets. And next week, we'll take a special look at residential. Thank you.